Welcome to The Explainer. Today, we're going to dive into a topic that, let's be honest, a lot of people see as super complex, maybe even a little controversial: technical analysis. But look, forget everything you've heard about it being some kind of crystal ball. We're going to open up the professional's toolkit and show you how it's really used to get a serious edge in the market. You know the feeling. We've all been there. You do your homework, you find this amazing company with a great story, and you're all set to invest. But then you're hit with that one massive question: is now the right time to pull the trigger? If you buy too early, your money just sits there doing nothing. Buy too late, you've missed the whole move. That when question, it's often the single biggest difference between a decent investment and a truly great one. So, how do we solve this when problem? Well, it really helps to think of investing as having two distinct sides. On one hand, you've got fundamental analysis. That's the stuff that tells you what to buy. You're digging into company health, value, all that good stuff. But on the other side, you have technical analysis. Its only job is to tell you when to buy. It's all about price action and timing. And here's the secret. The pros, they don't pick a side. They use both. They find those great companies, and then they use technicals to patiently wait for the perfect moment to act. So how does technical analysis actually help us nail down that timing? Well, here's the thing. It's got nothing to do with magic squiggles on a screen. At its absolute core, it's all about decoding market psychology. Okay, so what is it, officially? At its heart, technical analysis is a systematic study of two things, and only two things: price and volume. Now, that word systematic is super important. This isn't about gut feelings or random guesses, right? It's a repeatable method. And it's all built on one single powerful idea. And that big idea is this: the price. Discounts, everything. Think about that. All the news, all the earnings reports, the big expert opinions, how investors are feeling, all of it is already baked into that one number you see on the screen: the price. So instead of trying to chase a million different news stories, you just focus on the one thing that actually matters: the market's reaction. And this quote just nails it perfectly. Charts are not random lines, but readable maps of human behavior. A price chart, it's literally a map of emotions. You see those peaks, that's greed. You see those valleys, that's fear. When we learn how to read these maps, we're not trying to see the future, we're just reading the collective mood of the market right now. Okay, so philosophy is great, but how do we turn this into an actual practical strategy? Well, let's pull back the curtain on a framework that pros use to keep things systematic and, take emotion completely out of the picture. It's called the SEPA framework.
SEPA, it just stands for Structure, Entry, Price, Action, and Review. Think of it like a 5-point checklist you run through for every single trade. No exceptions. First, you look at the big picture, the market and sector structure. Is the wind at your back? Then you zoom in and pinpoint your entry. You check the price level to see if it makes sense. Then the most crucial part, you define your action. What's your plan? How much are you putting in? And where's your emergency exit? And finally, after the trade is on, you review it to learn and get better. See, it's a simple, repeatable process.
And this is where it all clicks. SEPA forces you to get specific. Let's look at this real-world example. For structure, okay, the banking sector is looking strong. Cool. For entry, we're not just guessing. We have a specific price range, 640 to 645. For price, it's trading at both key levels. And for action, and this is key, the risk is defined down to the rupee. See how there are no maybes or what-ifs here? It's just a clear, actionable plan. All right, so beyond a solid framework like SEPA, the pros are always hunting for specific, repeatable patterns. And one of the most powerful, one that's almost like a tell in poker, is called the Volatility Contraction Pattern, or VCP for short. So why is it so powerful? I mean, just look at this quote. It's the pattern that identifies stocks ready for huge moves before they happen. It's like seeing a spring coiling up, getting tighter and tighter, just before it explodes. So what are we actually looking for on a chart? Well, you'll see the price swings get tighter and tighter and tighter over a few weeks. That volatility just shrinks. And here's the dead giveaway. The trading volume just dries up. It gets super quiet. And that quiet, that's the signal. It tells you that pretty much everyone who wanted to sell has already sold. The path of least resistance is now pointing straight up. And just like any professional tool, The VCP isn't just a pretty picture. It comes with a full-blown execution plan. You enter when the price breaks out and volume floods back in. You place a really tight stop loss right below the pattern, to keep your risk tiny. And you already have a clear target in mind. It's a whole strategy in a box.
Okay, so does this stuff actually work? Let's take a look at a recent example from the Indian markets with a company called KPIT Technologies.
So here, the stock formed a perfect textbook VCP. It got quieter, the price ranges got tighter. It was basically shouting that the sellers were gone. The breakout entry was triggered right around 1180. And the result? Well, just 8 weeks later, the stock had rocketed past 1450. Yeah, that's a 23% gain in just 2 months. This is what happens when you combine the what, a solid company, with the when, a proven pattern that signals the exact right time to get in. Okay, now, I know what some of you are probably thinking. There's a ton of skepticism out there about this stuff. So, you know what? Let's just tackle the biggest myths head on.
This is the big one, isn't it? Isn't this all just chart astrology? Like reading tea leaves or something?
The myth is that it's just random lines. But the reality? It's the study of human behavior. And human behavior is quantifiable and, more importantly, it repeats. The same patterns of fear and greed that drove markets 100 years ago are driving them today. Because, well, we're still human. We're analyzing psychology, not planetary alignments.
And the second myth is that this stuff is a guarantee, that it's a crystal ball. It's absolutely not. A fantastic pattern might only work, say, 7 out of 10 times. So technical analysis doesn't promise certainty, it gives you a probabilistic edge. The real secret to winning isn't being right all the time. It's managing your risk on those 3 times you're wrong so you're still standing to profit in the long run.
Okay, so we've covered the what, the why, and the how. Let's wrap this up with a clear, simple roadmap you can start using to build these skills for yourself. Here it is, your path to mastery. First, get comfortable just reading basic charts. Then, force yourself to use that SEPA framework on every single trade idea. No shortcuts. Start building a process to find patterns like the VCP. Then, define your risk rules and make them non-negotiable. And probably the most important step, review all your trades, the good and the bad, so you're always learning and improving. That's it. That's how you build real skills. So we've taken technical analysis out of this weird realm of astrology and put it where it belongs, in a professional's toolkit for understanding the market. You've got a framework. You've got a high probability pattern to start looking for. So really, the only question left is, what's the first pattern you're going to look for in the market tomorrow? Thanks for watching The Explainer.